For more than 14 years, Kenya's dream of joining the elite club of global oil exporters rested on the shoulders of one British energy giant, Tullow Oil. It was a narrative of inevitable wealth. Billions of barrels of proven crude sat right beneath the Turkana dirt, waiting for Western capital to unleash it. But behind closed doors, a massive, quiet capitulation just took place. Tullow Oil didn't just finish selling off its physical operations in Kenya, it completely severed its structural ties to the country. In a sudden contract amendment, Tullow explicitly walked away from billions of shillings in future production royalties and multi-million-dollar options contracts. And they traded all of that massive long-term upside for a quick, upfront cash injection of just 1.1 billion shillings, about $9 million US. Think about that. In the world of international oil exploration, $9 million is corporate pocket change. It barely covers the cost of drilling a single deep exploratory well. So why would a global energy heavyweight look at a multi-billion-barrel oil field, drop its keys on the counter, waive its future rights, and run for the exit? The answer exposes a brutal reality about the state of global energy financing, a multi-billion shilling tax war in Nairobi, and a high-stakes local gamble that could either make or break Kenya's economy forever. To understand why Tullow just tore up its royalty agreement, we have to look closely at the architecture of their divorce. Back in July 2025, after years of project stagnation, partner exits, and regulatory roadblocks, Tullow agreed to sell 100% of its subsidiary, Tullow Kenya BV, to Orin Energy, an upstream affiliate of Kenya's local oil trading giant, Gulf Energy. The baseline price tag for the entire Kenyan portfolio was locked at a minimum of $120 million. But because frontier oil projects are notoriously volatile, the financial engineers structured this payout into 3 distinct tranches, explicitly designed to protect the local buyer if global oil markets imploded. Tranche A, worth $40 million. This cash was wired directly to Tullow the moment the transaction officially closed in September 2025. Tranche B, another $40 million. This milestone was unlocked and fully paid out in March 2026, immediately after the Energy Ministry and Kenya's Parliament moved to ratify the Comprehensive Field Development Plan. Tranche C. This is where the real drama lies. This final $40 million is bound to what insiders call the $65 price trigger. Starting in the third quarter of 2028, Gulf Energy is scheduled to pay Tullow $2 million per quarter, but only if international dated Brent crude prices averaged at least $65 per barrel during the preceding 3 months. If the market stays low, Gulf doesn't pay. However, there is a hard backstop. If the full $40 million hasn't been paid through these quarterly installments by June 30th, 2033, Gulf must clear the entire remainder as a single, massive balloon payment, regardless of what oil is trading at. This $120 million structure was completely locked in and legally binding, but Tullow still held 2 massive hooks deep inside Kenya's energy future to cash in on the long-term upside. Until now. Under that original 2025 framework, Tullow didn't just walk away empty-handed. They protected their future upside through 2 critical mechanisms. First, they held a lucrative royalty deed, giving them a right to a permanent quarterly payout of 50 cents for every single barrel pumped out of Turkana, calculated against 80% of total production. Second, they retained a back-in right, a zero-cost options contract that allowed Tullow to swoop back in at any time and seize a 30% participating equity stake in any future expanded development phases of Blocks 10BB and 13T. But in July 2026, both companies suddenly renegotiated. Tullow signed a pen stroke that completely extinguished the royalty stream and killed the back-in option forever. Why? For Tullow's executive leadership, this is a calculated play for near-term survival. Tullow has spent the last few years aggressively fighting to pay down massive corporate debts and streamline its global portfolio. The company's crown jewels are its high-margin, actively producing oil fields in West Africa, specifically the Jubilee and 10 fields in Ghana. In the eyes of Tullow's board, waiting a decade for Kenya to build complex, multi-billion-dollar infrastructure just to collect a 50-cent per barrel royalty wasn't an efficient use of corporate patience. They chose immediate liquidation to boost their balance sheet today, rather than a speculative promise tomorrow. For Gulf Energy, this was an absolute masterstroke of asset consolidation. By paying 1.1 billion shillings up front, they permanently eliminated a lingering tax on their future production. When the Turkana fields finally reach commercialization, Gulf keeps every single cent of the operational profit. More importantly, they completely insulated themselves from the risk of a foreign corporate giant swooping back in to dilute their ownership once the hard work of building the infrastructure is done. However, you cannot look at this sudden deal in isolation. There is a massive, unspoken catalyst lurking in the background, an active state of regulatory and legal warfare in Nairobi. The Kenya Revenue Authority hit Tullow Oil with a staggering $170 million, roughly 22 billion shilling tax assessment. The KRA asserts that Tullow owes massive back taxes on capital gains and VAT accumulated during the volatile transition period between 2020 and 2025. Tullow's public stance has been fiercely defensive. They have explicitly called the KRA's claims wholly without merit and have gone so far as to refuse to set aside any financial reserves or provisions to cover the potential liability, completely confident they will win in tax tribunals. But out here in the real world, corporate strategy tells a different story. By completely liquidating their remaining royalty deeds and surrendering their back-in rights, Tullow drastically minimizes their future legal and operational footprint inside Kenya. They are erasing their remaining vulnerabilities, packing their bags, and ensuring that any future legal battles with the state happen from a safe distance across the ocean. With Tullow completely out of the picture, Gulf Energy and its upstream units are now in absolute, uncontested control of Kenya's oil future. The entry of local capital marks the death of the foreign-led exploration era and the birth of a massive domestic gamble. Gulf Energy has signaled an astonishing $6 billion investment commitment to fully develop the South Lokichar Basin, boldly targeting first commercial oil production by the end of December 2026. But this local triumph comes with a brutal geoeconomic reality check. Kenya's crude oil is highly waxy, meaning it solidifies at room temperature. It cannot simply be dumped into standard trucks or basic pipelines. It requires a specialized, continuously heated export pipeline stretching hundreds of kilometers across the country to Lamu Port. For nearly a decade, Western oil majors and international syndicates proved they simply did not have the stomach to finance this immense infrastructure bottleneck. The capital expenditure was too high, the regulatory environment too volatile, and the environmental opposition too fierce. By buying out Tullow entirely and expanding cost recovery structures in their parliamentary production contracts, Gulf Energy is betting everything that local execution can succeed where multinational corporations failed. The structural ties are cut. Tullow walked away with its immediate cash. Gulf got absolute sovereign control over the asset. But Kenya's journey to becoming a legitimate oil-producing nation now rests entirely on local shoulders. The training wheels are officially off.